back, guys. What I want to talk next about is the options price movement, because I know that, one of the things I've said before is it's a misconception of how, the price would move, because, the way that we experience price movement on the actual stock, it translates to movement for options, but it's not always going to be directly one-to-one. Meaning that for every dollar up that you move, you're not going to move exactly a dollar up for your options, simply because they are, like we talked about, a derivative. They are a measurement of movement and ultimately a price that is directly related to movement, not just price. So one of the examples I have here, we're going to use some rounder numbers here just to keep things nice, is assuming that right now SPY is at $400, okay? Whatever the expiration that we're focused on here is that today, for a one-day type of expiration, just to keep it simple, the price for that was going to be $3.25 for the option, okay? Now, what that does mean, remember we were talking about how each option represents 100 shares. So when you look at these prices, you're going to shift the decimal point over to, and this is actually $325, all right? Now, when you pull up these numbers, you're going to see delta, gamma, vega, theta, all right? And what we got to understand here is that each one of these dictates how this price movement is going to move. It also gives us a little bit of a hint what type of risk we're taking. The first thing that stands out to me right here is how big this theta is. You're always comparing this to the amount that you have in the actual the price, because you're looking at it as a representation of how much it's going to cost to hold this option for 24 hours. I do want to point out theta is this situation of, we talked about per day rental, but theta on that last day is always going to have the most amount of risk, because if it doesn't attain this value, and let's say the market closes at $399.99, then the entire value of this option is going to go down to zero. It's going to be worthless, simply because if the market offers a better rate, what good and what use is this if it's on the day of expiration, right? So keep that in mind. It's important to realize that with these at the money and close to at the money, in the money contracts, that they always have a risk, especially when you buy these very, very short dated contracts. Now, what else? We got to talk about how delta and gamma, these two go hand in hand, but they affect the price when we go up and down. So for example, for example, if price goes up or down by $1 for the actual underlying stock, so here it's actually talking about SPY. If SPY goes up $1 or down $1, it's going to add delta or subtract delta. Okay, so I did the math here for us, and it's actually going to go up and down. Now, what ends up happening next is gamma is delta's, his movement component, his velocity, or you can think of, if this is velocity, this is acceleration, if you understand the math. What gamma does is it's going to add into it. So the next delta for this value is a little higher. If we go down, the delta value ends up being a little bit lower. Now, what I want you to consider here is that really important is that if we go down here, our delta value is lower. So if we do decide to go back and price comes down and then comes back up, what's going to happen here is actually it's not going to come right back up to the same value. It's going to be at about 321 or 320, because the 4-cent difference of your delta from that gamma is going to be, have lost, okay? And also, because that very likely took some time too, a small amount of this theta is going to be taken. It's not going to be such a large, not the full $300 here. But this is to remind you, though, if it doesn't achieve it by the next day, this value is very likely going to be sapped out and taken away. Now, what was Vega? Vega, I want you to remind you of is kind of, you can think of it as a bit of a multiplier, but right here, Vega isn't exactly large. It is that idea of volatility. Personally, Vega isn't the best number to look at. I would actually advise us to peek over at what IV or implied volatility is, because that's going to be given as a percentage like we were talking about before. And so when you do go look into your, your options chain, I want you to remind yourself that it's important to take a look here. First, take a look at what theta is going to look like, okay? Because that's going to be a chunk of what you're going to pay per day. But also notice that if you look further out, that theta gets cheaper because it's going to represent more days, but is going to be, a cheaper rental, but also is going to cost you more overall because you are paying for more time. In addition, I want you to take a look at implied volatility. For something like SPY, that 20 to 30, 35% range isn't too bad. But what you may notice from time to time is that you may come across particular trades or particular tickers that may have much, much higher percentage implied volatility. And in particular as well, on the day of expiration, what you may have is you may have a lot of these spike in volatility. There's a lot more traders trying to get in and out of them quickly in order to make these large returns. But keep in mind that type of behavior we call degenerate behavior and consider it a little bit more of gambling attitude if you're not sure of what's supposed to happen. If you're new to this situation, understand that these are warnings to you, that the way that we experience price movement, if this was SPY, you bought something at $400, it went down to $399, came back to $400, you have lost 0%. Nothing's changed. But in this situation, like I'd shown you, it's going to come back, and it's going to come back to a small loss because of the way that gamma and delta work together when price moves. Same in the, and understand that as well, it's not going to be directly one-to-one. These Greeks all work together. So theta is constantly changing as price fluctuates. Delta and gamma are changing. So you can understand that these are kind of like guidelines and a bit of, it is the mathematical calculations that are used by the market makers to make sure that their portfolios are balanced. These numbers come from the data that exists in terms of what the market's doing at the moment. These prices of the actual options are also being set by the market as well. These are all different different expectations of what price should be around. So, people will buy into these options. And what we're going to get into as we get into the market mechanics as well is that understanding these prices of the options market and the number of options that are being purchased also do end up moving things just a little bit when it comes down to influence on price. Open interest is often a good idea and a gauge as to what the market and what the people are looking at, what the market as a whole, the composite man, or what we consider everybody working together, what they expect over the next 10 days and where price is. There's always going to be some sort of mathematical distribution of people, and you can imagine the highest amount is something to consider. It's not always to think of it as where price is going to end up, because we'll talk about how market makers have a reason for max pain and etc. for these to expire worthless. But I want to keep in mind that when you're looking at all of your options chains, as much, theta, we, warn you, if you're trading the shorter term contracts are going to have higher thetas, longer term contracts are going to have lower thetas. So you can understand that time rental concept we talked about. delta and gamma influence our price, just like we talked about a moment ago. But the next most important number after that after implied volatility, like I'd mentioned too, the next most important number is this open interest, because you want to know how many people there are willing to buy and sell that same contract. So what sticks out to me right here is these are contracts that I would heavily advise against, because there's only 188, 130, and 233 open interest of this contract, meaning they're not very sought after. There's not too many people to potentially trade with. Imagine a marketplace with the only amount of people that want that specific contract and are willing to buy and sell it. So that's generally a bad situation to be a part of. You want to be in the pool of higher liquidity. You want more people to trade with. And as a result, keep an eye out for those open interest numbers, okay? Other things on here that you can kind of consider, we've talked about them, but they're not as important if you're doing day trading or getting in and out of contracts quickly, is you have a break-even value, right? So for example, the $400 one, $400 for the strike price, meaning you're looking to purchase this SPY, purchase 100 of these SPY equities at $400. You're purchasing it and this contract for this much. So if at the end of the day you do decide that you want to actually purchase those 400, each share would cost you this much money, because this is a representation of 100 shares of it. So there's a break-even price, and there's a percentage of how far we have to move to break even, meaning that technically if you were to hold this all the way till expiration, you need it to be at this price for you to be profitable. I want to remind you, break even, you shouldn't be thinking of, hey, will we get to break even? Are we going to hold this till expiration? That's not the idea, all right? But break even gives you kind of an idea of the premium that you're paying. If you notice, the higher the premium, the less likely that you're able to achieve those values. Imagine right here, you're saying right now it's $400, but you're willing to pay something to, break even at 426 or higher. That's a very large move. That's a 7% move, but that's again giving you 100 days. So you can see how they're playing the percentage move versus the amount of premium they have to pay. There's a delicate balance between how much you're willing to pay versus how far it puts your profitability as well, okay? The further in the money you go, the lower that break even goes, because you're paying a bigger premium, okay? Do you see that? How the numbers get better for break even in these situations as you go, okay? As you go further in the money. Last but not least here, volume. I should technically have this right next to open interest. Volume is good to see as, hey, what's actually been purchased and sold? And higher numbers always give you an idea that there's more interest and more people looking at those contracts and have already traded those contracts. But keep in mind, open interest is who's currently interested and have open orders ready to trade. That's always a good gauge as to what's going on and who's actually participating, who's got their hand up looking to trade right now versus who's already finished their trades or volume. All right. Hope that was helpful for today's understanding of how price moves with options. Keep in mind, Greeks are quite complicated, so it might take you a couple of times to go through these numbers. But again, understand that it takes a little bit of experience, takes a little bit of time in recognizing these and recognizing what are good option trades, especially because of the way that theta decay and the way that delta and gamma move, and overall how that works. Now you guys have an idea. With that being said, this is Eric signing off. I'll see you guys in the next one.